Good evening and welcome to the Australian Stock Market Show. With the All Ordinaries Index snapping a 4-week rally to close over 0.5% down last week, is selling here to stay for the month of October. Stay tuned as we'll discuss our thoughts on that shortly. We'll also take a look at the sectors in the Australian market, and for our main topic in tonight's show, we get into passive income, how the wealthy get rich effortlessly. First up, we'll share our hot stock tip for the week, so sit back and relax. Again, tonight is jam-packed as we have lots of emails to answer. We'll also take your phone calls and give you the answers to some of the important questions around the market. Tonight we're excited to share our thoughts on some great stocks like BlueScope, Magellan, Westpac, the Australian sectors in the Australian market, and more so. Get comfortable as we'll get into those soon. I'm Dale Gillham, the Chief Analyst here at Wealth Within, and I'm your host for tonight. And joining me, two of our team of highly experienced professional traders, Janine Cox and Philip Tortevsky. Wealth Within is Australia's most trusted stock market educators. Good evening, team. How are we today?
Fantastic. And yourself?
Me, I'm super fantastic. I'll get better later on too. I might get a beer later on if I don't get home.
Well, sounds nice.
Sounds nice anyway. And you're doing well?
Yeah, good. I mean, you're probably sick of me talking off air about how I could have been a 5-time Brownlow medalist, but...
Well, I am a little bit sick of it, but you probably need to be in a Collingwood jumper to have that kind of ego. Anyway, tonight, as mentioned, we do get into the Australian sectors, but let's look at this week's hot stock. Phil, what have you got for us tonight, Brownlow medalist?
All right, so tonight's hot stock tip is Nickel Industries Limited, a stock ticker code NIC. So let's get straight into it. On your screen right now is the marketindex.com. Now, they've given us a very extensive description of what this company does, but we'll keep it short and sweet. It's basically a low-cost producer of nickel pig iron, a key ingredient in the stainless steel production. So, you know, one of those key, metals that is used in a lot of industry there. But what's really exciting about this stock is that the company is transitioning its business towards the production of Class 1 nickel suitable for the EV battery supply chain. So moving with the times. And it's nice when you see companies like this, because we've spoken, in previous shows about how companies either get stuck in that fossil fuel stage or ones that are moving with the times and evolving with the greener future. But getting into some performance with this one, it's got a 2024 year-to-date return of positive 33.81%, a one-year return of positive 30. It is beating the sector by 27% on a one-year basis, and it's also beating the ASX 200 by 12%, so really performing at the moment. It's got a market cap of 3.8 or 3.9 billion, just under 4, and it is ranked just outside the top 100. So let's get into the important stuff right now, which is the chart. And I want to start off on the monthly chart first to bring up a bit of a big picture view on what's happening. And clearly you can see this stock, had a really nice expansion phase out of 2018, found a reversal in March 2022, has been falling since. But what's real interesting with this one is if we have a look at this momentum line we've got, it's pretty much touched it on the long-term gradient of this upward swing in January 2024. Which is almost pretty much exact. So that's quite a nice bonus. But what I've also marked is this horizontal level, which sits at around 69 cents. Now, to me, this is the most important level of support and resistance. You can see it's touched it on multiple occasions back in 2019 and again in 2022. And, when we're looking at stocks that are coming out of these significant falls, what's important is to identify, we always say, where's this strong reversal? Because at the end of the day, it's identifying the key reversal point after a big fall that's going to give you that opportune moment to get in at the best risk reward scenario. And right now, things might be playing out that way with this one, because if you have a look, the second largest rise was about 70% back through 2023. We've had a big shootout of 100% from 2024. And if you just hover your eye through here, you'll notice that where I've got marked with this green dot, it is the first time we have confirmed a higher base all the way since the all-time high back in 2022. So we are on the monthly chart. That's something not to be sneezed at. We could really be turning the corner with this one. Now, I just want to go quickly to the weekly chart to finish things off. And I've got this really nice horizontal rectangle box marked. And to me, what that shows has been a real strong agreement in price at about 80 odd cents since having a recent pullback. And so the stock's broken out of that. We know when they do break out of these congestions, like we saw throughout this period, they either break up or down. We've broken up, so expect expansion. And I've marked a level in the short term of about $1.10, where you could see some short-term resistance, still presenting about a 21% upside. So as always, it's all about right now getting that risk-reward scenario in play and finding that strategy to capture even the short-term moves that are on offer right now, but even to the bigger picture, potentially the long-term moves if this one really has found a base.
Well, that is it for our weekly hot stock tip. Now, shortly, we're going to get into our topic for the night, but before we do, right now is your opportunity to get involved in the show and have your questions answered. Now, remember, call now on 0392909988, or you can text your question to the number on your screen. Now, the first call into the show right now gets a free copy of my book, Accelerate Your Wealth. So pick up your phone and dial 0392909988 and do it right now. So whilst we do that, or whilst you do that, tonight we're going to give you our thoughts on the sectors in the Australian market. So let's get into it.
On your screen right now is a watch list of the Australian sectors. Let's have a look at what we've got. Phil, on the list. Okay, at the top of the list there is information technology. Now this is obviously over the year to date, 45.87% up on infotech, coming back there. Financials, 21.5% up. That's looking nice. We're questioning whether some of the banks have got a little bit more to go in some cases and whether some might be turning. The real estate sector's doing well, up 20.55. That's really interesting in itself, and I'm going to be talking about the property index shortly. Consumer discretionary up 16.3%. Now, you know, we know that consumer discretionary was one of the laggards for a while, or usually hangs around the middle of the list, but it's moving up into that top 50% now. Utilities up 10%. It's good to see utilities moving up, but again, that is rarely do we see utilities at the top of the list. It sort of hangs around the middle most of the time, and I think it's really important to for people to get an idea of where particular sectors hang out, so they can look for the highest growth or more steady growth, or sectors that tend to pay better dividends. And some of these do, and you can find that in discretionary, you can find that in real estate and financials, which is interesting. We said financials would be at the top, and it's already moving up that way. Healthcare, we think there's some opportunities in industrials and healthcare. Industrials up 7.46, healthcare's only 5.92. So there's got to be some more room to move in healthcare, wouldn't you say?
Oh yeah, and I mean, I'm looking at the bottom end of the market, which is materials and energy. Now, materials, although it's still down 9% for the year, it's had some really strong runs over the last 3 weeks. So perhaps are we seeing a low come into materials? And you know, like you said, healthcare. Obviously, if we get the golden, I guess, combination of financials, materials, healthcare, and energy rising up together, then there is no way our market's falling.
Yeah.
And so, you know, with materials coming out of that significant low over the last 3 weeks, financials having a very, very uniform full pullback. They're not going to go up forever in a straight line. And now you're starting to see energy come back as well. I think if you're not watching the market right now, you really need to be.
But I wonder if energy will ever be at the top again, like, you know, given how strong infotech's been, and if materials makes its move up. Yes, energy could move up, maybe into the middle, maybe even to the top 50% of the list, but will it go to the number one?
Look, in history it has. I mean, and I'm going to bet with history they're not, you know, and with energy, obviously, you know, there's that argument, the new wave of renewables are coming into the picture, but like we showed in previous shows, big investors like Warren Buffett are still betting on fossil fuels.
That's right.
And so I'm not going to be one to disregard energy at all.
You're not going to go against Warren?
How can you?
Well, I could, but anyway, that's fine. But we have seen a bit of a reversal in the last couple of weeks, haven't we? Like, I mean, obviously materials took off for 3 weeks, but last week we had financials down, which has been a big moving sector this year. And we've seen healthcare take off, which is all the sectors we were talking about. Healthcare and energy took off, and energy is the worst performing sector this year. So I think some good upside on there, but I think there's plenty of opportunities we can look at, yeah?
There are. Look, property's a good one for that. It's just had a rebound. If you have a look at the chart just quickly there, you'll see a nice extended rise there up on the monthly chart. You can see the weekly on the right. But it's broken through all of those prior highs, which has got me really excited. So, you know, we could see this sector eventually move on up and challenge that all-time high back at the GFC.
I mean, with these real estate stocks, we've, you know, even on the shows we do on Monday, we are constantly looking for new stocks. It's the real estate stocks, the REITs that are showing fantastic setups right now. So that's another sector. I'm with you guys. I mean, if you're not watching it, that's one. It's a must right now.
I agree.
That it? You
That's
agree?
it.
No argument, no nothing.
No, I haven't got my boxing gloves on today. You're safe.
It's on safe. Well, anyway, that is it for our thoughts on the Australian sectors. Now, before we get into our first email, remember to get your questions answered live on air, you will need to text or call into the show. You can also send your questions to info@wealthwithin.com.au and we'll answer them in next week's show. But let's get into our first question. Now, our first email is from Daniel. He's asking, can you please give me your thoughts on BlueScope Steel? It's on my watch list, a longer term trade. The stock has had a recent pullback on the monthly chart and historically runs really well following such pullbacks. Now, I'm thinking if it can clear resistance at around $25.67, there's enough upside based on back testing. Coupled with the initial measures, basically about the China stimuluses to their economy. So let's go and have a look at this stock. What do you take it away, Phil?
All right. Yeah, look, a good play. I mean, obviously with the stimulus that's happened in China, obviously the materials sector shot off like a rocket recently. And BlueScope Steel, the stock right now, it is still tracking sideways big picture. Obviously we're on the monthly chart here. I don't mind the idea about buying above 25.67 if this is a long-term proposition, which I'm not too sure whether we got that in the email, but regardless, if we zoom in, the stock is still kind of in this chop right now. It is starting to rise, giving us those higher highs and higher lows, but it's doing it in, can I say, a sloppy type fashion. It is still a bit choppy, so I would like to see the characteristic change of BlueScope Steel, and a move above 25.67 would definitely confirm, you know, we've broken up above most of this, I guess, choppy type price action. And it's one thing getting above there, but I'd like to see how it does it. If it can start moving up with some strong expansion, you know, give us really strong expansion on a 1 month, 2 month basis, more like we saw coming out of this period through here, then I would argue that, hey, potentially we're going to get higher. But just be careful that there is this previous peak in August 2021, which could still act as resistance for the stock. So perhaps another play could be wait for it to even get above $30 and wait to see what it does on the flip side of $30. That's probably the safest option.
What do you think?
Look, I was just thinking, looking at this period back here in 2013 through to 2015, there was an interest rate change in the US at that time, and then I remember the market just going sideways for a while. We've just come out of a sideways market though. But I was wondering, could it just perhaps go sideways for a bit longer? I mean, it seems trapped like Phil's saying. A strong move above there would be better. If it just sort of traded up and sort of just poked its head above the April high, I wouldn't be that excited about it. But if it moved up strongly through that level, I guess I'd start getting more interested in it.
I mean, this is a stock that's quite cyclical in nature, isn't it, this one? Because I know it's like BHP, it's always been traditionally 5 years in its cycle, but this one is pretty much 5 years. And we've got to remember, BlueScope Steel was part of BHP. So,
Good point.
And if you're looking at the chart, we can actually see that roughly every 5 years there's a low on that stock, so which is roughly about now. And to me, that is exciting from a point of view of, I think it's got a lot of upside from there. But anything else you want to add to it?
Oh, no. Janine?
No, like if you're thinking that there's a 5-year low now, or you're suggesting that perhaps that could mean it's already had it. That's what you're saying, isn't it?
Yeah, anyway, well, thanks for your comments on BlueScope Steel. Now we have Samit, who was asking, I just wanted your opinion on Kogan. I currently don't own the stock, but it looks like it's setting up for a new uptrend. I have missed a couple of entry signals on the weekly chart on this one, and I'm not sure if the run is over as it's reaching a significant resistance level around $5.30. I'm looking to buy for the short to medium term. Now, Janine, what do you reckon?
At the moment, I think this stock is still about the short term, Samit. So I think it's good to think about, you know, short to medium term, which will it be? I agree with his level. Really, you need to wait for it to get through that level. I'd prefer to see a bit of a pullback down from this level just to give a bit more confidence, because if you're looking at the monthly chart, you can see it's only really just broken off that low, and there's so many stocks can do this sort of thing after a big sell-off and then they just flip down and continue to trade lower. But look, I'd preferably something else. I'd want to see something more on that monthly chart, a bit more of a push through that level he mentioned.
Well, it very much, to me, I totally agree, by the way, but it very much resembles this period through here, October 2018. We saw that real blow-off run down to the November 18 low, and look what followed. It wasn't instant, it wasn't strong. The market, or I guess this particular stock, Kogan, found its base twice, made those higher lows, and then had another real blow-off, finding support. But basically the point was it was testing lows at a higher level. Now, coming out of this particular low, we've only had 1, 2, 3, 4 months where it's tried to rise, and it's not even got into where the selling really started. So that's a bit of a concern, especially when you're talking medium to long term. The stock really has a fair way to go. And if we just go back to the chart, even if you wait for it to get above where the selling started, which is this March 2024 high, if we just relate it back to the 2020 period, you still haven't missed out on that much. I mean, you've gotten in at the safe level through that high, and look what followed. So I would just argue, don't be too eager or too early to get on this one, because you might be stuck.
Good, wise words, I think, from both you and Phil, Janine. But I'm sure people will be looking at this thinking, well, if we're going to drop interest rates, that means there's going to be more free cash, then a stock like this would start to take off. Wouldn't you expect that sort of stuff to happen?
Yeah, initially.
Retailer, yeah.
I mean, or is it just struggling with competition, with people buying from Amazon and stuff like that as well, and other online retailers?
Yeah, we've got to support local, don't we?
Well, we hope so. I mean, obviously Kogan brings goods in from overseas, but at least the profits from Kogan will stay in Australia, whereas if you're buying from Amazon, your money's going offshore. And same with eBay, with people, there's profits going offshore all the time. So I'm with you in supporting the Australian economy. But when are we expecting interest rates to come off? What's your take on it? Well,
look, if we get a really strong Black Friday, I don't think we're going to see a cut any time in the next 3 to 6 months.
So we won't see a cut.
If it's a very strong Black Friday and everybody gets out with their credit cards and spends a lot. But if it's not, if it's lackluster, then I think it'll be sooner rather than later.
So when? This year or early next year?
Look, potential for December if that happened, but if not, it wouldn't be until the end of the first quarter.
Oh, there you have it from Janine. Well, that is it for our take on Kogan now. Earn money while you sleep. Sounds awesome, doesn't it? For some, it's a dream, but for the wealthy, it's one of the main pillars in how they become rich. Now, making money while you sleep requires you to generate passive income streams, and there are so many ways you can earn that money in your sleep. So, what's the best way to create that passive income for yourself? Well, we'll get into that shortly, but first, let's start off by discussing what passive income actually is. Now, put simply, it's the process of building wealth without trading your time for money. Sounds great in theory, but sometimes reality isn't as simple as the theory. Now, checking out this quote from best-selling author MJ DeMarco, the big irony of passive income is that anything is passive. Every single entrepreneur I know who enjoys passive income today exercised an extraordinary and committed process to it yesterday.
That's
is this
really
sort of like what
it.
Buffett's quote is, you're enjoying the shade because you planted a seed a gazillion years ago?
That's really good. I'm sure he'd be really excited to hear you say that.
I don't remember the exact quote, but you know what I mean. He's got some great quotes.
Look, I mean, there's nothing out there that you're going to find that creates passive income that doesn't require at least some work up front. That's just the reality with investing in whether it's property or shares or whatever it is. So it's about putting that work in up front, and then once it's set up, in theory, you just reap the reward after that. But it's finding the right investment for the right individual. That's the challenge.
Well, it's investing time and or money, whether you're an entrepreneur or an investor, a trader, property, shares, whatever that is. There's time and money that you've got to. To me, there's an old saying: you don't get something until you give something up, and that giving up is time and or money and or both.
Well, a lot of people have gone for online businesses because the theory is that if you can sell some consumables, that there's the repeat business there, and you don't need to put in the same amount of effort to get that repeat business. In theory, it just comes in by itself, but it doesn't always happen that way, and that's the big
And
thing.
you got to set it up and manage it anyway from that point of view. But anyway, the two most popular forms of passive income in Australia are property and shares. Now, take a look at this graph from CoreLogic that shows residential real estate making up the largest portion of Australia's wealth, twice the value of the other three areas combined. Now, if you've never invested in property, it isn't a hands-off as you might think. So, Janine, is property investment really the best passive choice?
Yeah, that's a question that's really pondered by a lot of people. There's a lot of information about this online that can lead you astray. Now, the issue with this is that when we look at big picture, around 30% of investment properties are actually for investment, aren't they? So when you think about those numbers and you think about how many Australians are actually investing, it's a very small number relative to the number of properties that are out there. But I think more people should be investing in property and shares. But the issue with that is that it depends on the situation, whether it's the best choice for you. And there's a big deposit up front. If you're wanting to buy property, you've got this massive outlay up front. You get slugged with stamp duty. It's nice of the government to do that at the start when you're doing something to help the economy.
Land taxes.
And there's all sorts of other taxes.
Living in Victoria taxes.
Then you've got to worry about the yields. So there's that side of it as well. There are lots of ongoing challenges when you've got property, but at the same time it's also very rewarding, so you've got leverage in there as well, which you can get with shares. But a lot of people are going for shares because it's simpler than property.
So true, but you do need deep pockets, and unless you buy the right property at the right time and get the right tenants and have the right agent, it's not as passive as it may appear. Now, I'm going to go to you on this one, Phil.
No, I mean, and you said all the right things. All these things require work. Getting the right tenant, getting the right property, and then there's maintenance as well. If something breaks or damage, what have you. But more important than that, when you're talking about passive, to me, it means you walk away and there's nothing to be done. And
that doesn't exist.
It doesn't exist in anything, I don't think. And to the point as well, when you said before the land tax. Now that's just come out of the let's just say out of nowhere, and investors that are holding property now have this new dimension to deal with. Just sitting on your hands won't fix the problem. So you've got to make a choice now. Do you keep the property or do you get rid of it? So it's definitely not as passive.
Dealing with accountants, solicitors, property agents, the rest of it. Yeah, I know exactly what you're talking about. Well, historically, property has been attractive because of leverage and the tax deductions, but both property and shares allow you to create multiple income streams with the potential for capital growth. So, which is better for passive income? Now, I'm going to go back to you again now, Phil.
Oh, look, I mean, again, like Janine said, it's weighing it up. But to me, the best way to weigh it up is you look, figures with figures. Now, if you're talking property versus shares, look at dividend yields, average dividend yield around Australia, and then measure that to the average rental yield. The liquidity is also the biggest issue that you've got to consider as well, where how liquid is your investment to be able to close at any moment that you do need to. I know with property you've got to pay, as Janine said, stamp duty, go to auction, these things take time, whereas you buy $1 million worth of BHP today, you could sell that same $1 million worth of BHP tomorrow. It's not going to cost you what it is to sell a house. So you need to really consider the liquidity of the investment you're undertaking and also the barrier to entry. I mean, not everyone has the deposit these days to get into the property market relative to what you could get exposure to. And
especially young people today.
Yeah.
Well, anyway, shares allow you to leverage to amplify your returns. I want you to discuss this one, Janine, because we've done a lot of that with our traders and teaching people how to do that.
Yeah, look, I mean, it's all about being able to use the leverage and then to maximise the base. That can be done with property and shares, but also to be able to use the dividends or the interest to pay the debt, the interest on the debt. So that's the key here. And so if you can get that sort of nice balanced equation to be able to do that, it really can work well to help you propel forward. You can buy more shares with it eventually. So the more shares you've got, the more dividends you get, and the more your wealth grows, the more income you get.
Yeah, I know a lot of people are scared about using shares by borrowing money to do shares. They do it naturally for property, but they don't necessarily do it for shares, and it's a real sad thing that they don't do it. But anyway, when I talk a little bit about the risks, most often or most information online talks about what you can make and ignores what you need to know most, which is your risk, which is what we've been chatting about. And there's a level of risk with any investment, especially when leverage is used. So let's explore what's important to consider when you're actually leveraging. Now I'm going to go back to you on this one, Phil.
Yeah, I mean, well, obviously the cost in terms of what you get and how much you're going to pay to hold that investment, over what time frame you need to consider, how long you're deciding to hold these investments for. And then apart from that, it's, you know, some of the rules around when you can, because I know with margin loans there are rules about how you can invest that money, how you can get rid of that and all that kind of stuff. So there are a few things to consider, but I mean, at the end of the day, really it's a leverage used right, regardless of the instrument, you can really use it to your benefit.
Yeah, I found it's easier to get into a cash positive or at least cash neutral with shares than it is with property.
Oh, yeah.
A lot easier, but that's a whole nother story, isn't it, guys? Well, anyway, if you like this subject, make sure you hit that like button and subscribe to the channel for more tips on trading and investment. Also, comment below the video on what you want us to share with you in future shows. Now, okay, let's shift gears and talk about strategy. Collecting dividends from stocks can be effortless if you get this right. But what's right, Janine?
Well, that's a challenge, isn't it? Because it's got to be big stocks. A lot of people try and pick the stocks.
Got to be big stocks.
Well, they pick the stocks with the biggest dividends, which is really not
That's
the right.
different than big stocks,
isn't it? You know, which can be higher risk. You're taking on more risk, but the idea is to make this a really simple process and strategy, a lower risk strategy. So if you want something that's passive, it's not going to be completely passive, but we're going to show you how to make it with as little effort as possible in managing shares.
I mean, you know, to me, traditionally people think, you know, like bonds and bank term deposits are passive investments, but even then you need to roll those over. And even managed funds, people treat them as passive investments, but you do need to look at them, otherwise you're not going to get great returns. So wise words from you guys at the moment. Now, I totally agree with you both in this, but with the rise in popularity of ETFs, a new option for earning income from the stock market has become available. And if you're thinking of heading down the ETF path or are already in ETFs, I'd encourage you to check out this article that I did on the risks of ETFs. In fact, with ETFs being marketed as diversified, stable investments, it gives you the impression that you can take a passive approach while you collect dividends. Now, I'm going to give you a warning. You'll lose your profits and your capital in the next crash if you fail to understand how to manage the risks with ETFs. They're definitely not a passive investment like they promoted. Now, are there other passive income options, Janine?
Look, if my teeth start chattering, it's not because I'm scared of you.
Where did that come from, Phil?
I'm just sitting here freezing.
The temperature's cold.
I'm going, I'm just about to talk about it. Look, what I want to talk about is REITs.
Calm down.
Now, take a deep breath. REITs. Now, REITs are a really good option for this because they can pay you out quarterly instead of twice a year. Some people think I'm investing for dividends and for income. Who wants to be paid twice a year when you can be paid 4 times a year and have different cash flow? But they do need to be managed as well, like any share, over the medium to long term if you're looking to do this for income.
Well done. You didn't chatter once on your teeth. Go. Anyway, well, I think it's time for some stocks. How about you take over, Phil?
Yeah, okay,
and heat
sure.
things up in the room.
All right, so let's go to the charts right now. We're going to start off with a watch list first and just go through some options. Now, last week we spoke about dividend stocks versus, I believe, term deposits.
Yes.
And we went for the more reliable type dividend, the ones that, you know, have been around for a very, very long time. So we've decided to pick a few different ones now. We've gone with 2 REITs that we quite like, some ETFs, property sorry, let me say that again.
Okay.
2 ETFs, 2 REITs, and also 2 stocks that pay quite a nice dividend. Now you can see on the right-hand side, we've got 11% yield for Cromwell Property Group, Fortescue 7.8, Growth Point Properties 12.85. I mean, these are some very, very high numbers when you're talking about dividend. And obviously, like Janine said, you've got to consider when you're invested in stocks or any of these REITs, ETFs, that they do fluctuate. So your capital is at risk for moving up and down. But I mean, with yields of double digits per year, that would factor in for a lot of that volatility, especially when you're talking about, you know, things like REITs, which aren't traditionally the higher moving or much more volatile.
And a lot of those dividends would be franked at least,
Yeah.
partly, but most likely
Yeah,
fully
Westpac.
franked. Westpac can be fully franked.
I mean,
which
that's
is,
why you can't go past the banks for this sort of strategy. And I really like Westpac as one option for the medium to long term. Fortescue can be good, but at certain times, it's a more riskier proposition, but get in at the right time. And you get the dividend and you get good capital growth.
all right, so let's look at some charts.
Yes, and I mean, just to that point, at the end of the day, it's one thing just looking for that dividend alone, and if you can overlay an understanding of where the money is flowing, where the market is moving, and for example, materials right now, get good entries on those charts, and then overlay the nice income as it's in an uptrend or rising. I mean, that really is the
Money for jam.
the golden formula for trading.
I mean, there's some other bigger property stocks we could have talked about, but I mean, Cromwell's sort of like on the border. It's a smaller stock, of course. It's only 45 cents. So therefore, that would probably be at the bottom of my list in terms of choices, but it might actually be good if you're looking for growth and income.
So let's bring up a chart.
All right, Fortescue Metals first. Now, like Janine said, obviously this one is more volatile, but if we take away, I guess, our short lens and go big picture lens, if you're buying this stock anywhere from 2009 onwards post-crash, or even if you've bought it up in 2008 and you're really a long-term investor thinking, hey, I just want income, I don't really care about the capital movement, which, again, you should, but regardless, aside from that, you'd still be in a profitable position all these years later because the company is growing, it is rising. We do see extended volatility, but right now it is coming out of one of these significant falls. Now, going through the history of this stock, you've seen a particularly strong fall that's happened recently, but throughout history, it hasn't happened too many times to that, I guess, gradient of fall. We've seen one back in 2021 July, which was very, very similar, and look what followed. And then the third one, which was back in 2008, very similar type fall. Not this very slow or, I guess, uniform type downtrend, which unfolds from time to time. It's that real flush out, which is what we're seeing, generally signifying not the euphoria, but the fear, the bottom end of the move. So
I think the challenge is for people who are looking for stocks for income is that you want stocks that you can actually be pretty confident that you're going to get paid, so some reliable stocks, but you don't want to have to give it back through high volatility, which FMG could be one of those shares that does that at times. But then if you manage to get in at the right time and when it's low enough, you'll be able to get that decent dividend. But right now is not that time. It's still, I guess, threatening to the downside. It's not moving in the right direction yet. But if we saw it move above last month's high, it's probably more likely to be heading in the right direction. You might even get some good rules on the weekly chart to be able to pick it up.
Cool. So we like materials. So we got another chart.
we sure do. Next up, we have Westpac Bank. Now, I mean, like Janine said, how can you go wrong with the bankers? Obviously, Westpac Bank is one that, when you compare it to CBA, doesn't look the same chart-wise. It is still failing to break through to the all-time high. But if we zoom out on a much bigger picture, really, if you're holding this long-term, you've only ever really had to experience two real significant times in the history of this stock where, you're probably in drawdown or experiencing the stock in a relatively decent downtrend. And that is...
But a trend line would fix that anyway, wouldn't it?
Well, absolutely, and that's that's the point right there in itself. Obviously, we're talking about being ultra passive, but just a little bit of tweaking on that ultra passiveness, and even just watching charts or following your investment once a month, 1 day a month, 1 hour a month. I mean, it's not much work for what you get to save in the long run. And what Janine's talking about is just if you were to apply some of these trend lines through the stock as it's rising, you can really protect your upside. And then, get in at those opportune moments when it comes next. So you're going to get the benefit of both income and capital growth, not just income and fluctuation up and down, but purely passive type approach. Obviously, these two periods back in 08 and 2015 were the strongest in terms of downfall. But now, I think this stock's on the flip side. It's obviously found big support at $14, $15 if we apply this horizontal line through here. And we've given one of those patterns where it's broken out and then consolidated at $21, very textbook type of pattern formation with an extension now. So right now, is it an opportune time to buy? To me, it looks a little extended, if I have to be honest, in terms of the way it's run. You can see that, relative to this particular period through here, as it's running, it looks very similar. And what followed was a really nice pullback through there. So right now, I would, be waiting for a pullback on this one. In terms of trying to identify that best opportunity, but that comes with a caveat too, because long-term investor looking for income, doesn't probably need to consider the best entry price.
No, they don't, and because they're looking for long term, and long term, this stock's bullish.
Exactly.
You know, I don't think there's any risk on that one, and there's quite a few stocks that are long term bullish that we're seeing right now. So can we look at another chart?
Yeah, they're not if you think about a lend lease, you just wouldn't put your money into that sort of a stock. It's not the same, although it is coming off a low now rather than being in a decline. So that could be different from a growth point of view.
Good stocks that trend long term, like CSLs, your Cochlears, your
Woolworths.
Wesfarmers, your Woolworths, those sorts of stocks. So we're just showing them a couple of other different ones that they could be using at the moment.
Exactly, because we covered off other stocks before. Now this is one that's a little bit more on the growth and income side of it, just for those people who can manage a bit more volatility on stocks. So Cromwell has had some good runs as well. For a property stock, it just has a stellar run here prior to the GFC. And its decline actually is interesting. If we just look at the percentage fall, we'll have a look now and put that on the high there. But this is the sort of thing, you need to get to know the stock before you decide to pick one. Don't just think, oh, I'll just pick Westpac because, Janine and Phil and Dale like it as a stock for income. Go and have a look at how volatile it's been in the past and think about how am I going to manage that, and if it started to pull back, where would I sell? Just look at the history, and it gives you an example to test yourself. And if we look at this high here as well, we can see the sort of volatility to expect. So it does have these drawdowns of over or around 70% when it does fall significantly. But given where it is now and this support that it might have, we might get a really nice amount, decent capital growth and get some good dividends along the way.
Oh yeah, I mean, just how you've drawn these levels, 76% and 70%, really we're coming into the full extension of what we've seen with this stock in terms of drawdown, as Janine said. And right now, this particular pattern that's lining up, we've seen it time and time again on this show, the market starting to rise out of a low and then finding that base and accumulating sideways, which it seems like it's doing at 40 odd cents. If it can get through 47, almost 50 cents, let's say, then I think it's going to, at least provide some short-term sharp volatility to the upside. Whether that transitions to long-term, you probably want to see it get above the 60 odd 70 cents for, more confirmation that long-term bullish move.
Now let's say you bought a stock for income, right?
Yeah.
And the stock falls away below your buy price. How would you manage a stock differently for income as you would for capital growth?
We'd have to allow a little bit more leeway, wouldn't you? Because if you think it's long-term bullish, like we're talking about with Westpac, but it's going to come down for a few months and maybe come down 30% in price, let's say, that would concern you as a trader. But if you're a long-term income investor, it probably wouldn't concern you as much.
And you've also got to factor in that, whilst the stock may be falling at a particular point in time, it might be falling around the time where you're due to collect your dividend. And so, you're getting into that moment, it's like, well, I don't want to push that sell button because now I'm going to lose my dividend and potentially the franking.
That's what happened with Combank the other week. It had a dividend, it had a big down week, and then the next week was down. So,
But that's different though, because it's been so bullish. But if it was in a decline, and then you can see as an analyst on a chart that it could, not Combank, but any stock, could have a significant fall, then you're not going to hang on to it for
that's
a couple
what
of
I'm saying
percent.
is if you've got a long-term view, well, how far are you going to let it fall? Is it 10%, is it 15,
I
is it
think
20,
that's a
is
good
it
point.
25,
Just
is
make
it
up your
30?
mind.
So make up your mind and be happy with that. If it goes past that, can get out.
And your buy price can help with that, because if the stock's fallen 8% and you're about to collect an 8% yield, well, it might be worthwhile staying.
Because when you get the dividend, it effectively is lowering your buy price, isn't it?
Yeah.
Really, because it's money coming back into your bank account. So you're getting your capital back as such.
I guess you've also got to be thinking about if a stock's going ex-dividend by that sort of figure, it could fall by that and more.
Potentially, yeah.
And that's where the
All
technical
right, next
analysis
chart,
is great.
move on.
It tells you.
All
Yep,
right.
All right.
Next up, we've got another REIT, Growth Point Oz. Now, what's interesting about these REITs, which Janine mentioned earlier, is the fact that, this is a very viable option if you want exposure to the real estate market without buying property, or if you cannot get into the property market. Obviously, the deposits these days are astronomical, even for the average type property. So if you want exposure, you think property market's rising, you think interest rates might be falling, then these kinds of REITs are really ones that could be appealing, particularly with the overlaying. Sure, you're not going to get rent, but you're going to get
I know, and people think, oh, look, that property's a bit more exciting because I can see it. But I mean, you can see the chart, you can see what the shares are doing, what the company's doing. And look, if you'd bought off that bottom after the big correction in the GFC, you'd be up 319% to that high.
Has property gone up that much since 2009?
it might depend on where you bought.
Areas have done really well, and other areas haven't done that well. So it really is depending on where you are in Australia. So, but property is looking good at the moment. It's looking better. I mean, it's down, but with the talk of interest rates dropping away, there might be some more interest starting to come back into it. But right now, it's a bit too early, I think. But as they say, there's never a bad time to buy a good investment. Just better times.
Yes.
True.
Another chart.
Yes, we sure do. All right, next we have Vanguard. Now we're moving into the ETFs, and I want to bring up the monthly chart here to start it off and just give you a really visual view that for those thinking that ETFs aren't volatile or are quite stable type investments, well, think again, because look at this through March 2020. In 2 months, you're going to see volatility. Now, although in terms of the price percentage, it might not be as much as a stock, if I can just
And
find...
it did actually go through that pre-COVID
the price
high, didn't it?
Yes. But I mean, look, that looks like 38%. But I mean, if you're looking at it, and we're on a monthly chart here, so regardless of the percentage move, it's still moving much, much more relative to the, natural volatility of this stock. But we do experience months on end when it falls. April, March 2015, it's fallen away. But aside from all that, we're talking about a high shares yield ETF. So this is exposure to high yielding income. And right now it looks quite nice. I mean, it's really done the same kind of pattern that the market's done, accumulated over the last 4 years or so, broken out. Now it is really measuring the way the market is going, broken out to new all-time high in September 2024. So, I mean, one option that if you want to take away all that stock-specific type risk that comes with stocks,
Or you could have one of your positions in your portfolio could be this, or a certain percentage of your portfolio could be.
absolutely.
All right, next stock.
All right, we've got another ETF. So this one is actually the Vanguard Australian Property ETF, which, this one might surprise some people because of the volatility of it. It would depend on obviously the stocks that they were holding at the time. This one actually fell more, about 50% during COVID, because we know that some of the property stocks were more volatile. Look what happened if we just go back to jog your memory as to what occurred on some of these property stocks, not this one, but I think it was that one. Yeah, this is typical of what happened on some of the property stocks during a major financial crisis, which is why you need tools to be able to manage them. Even though you do get paid 4 times a year on these stocks, it's really important to make sure that you don't give it all back. So looking at this, a lot of sideways moves comes from property investments until the market goes into that boom phase, because once the market goes into the boom phase, these sorts of stocks do take off, and ETFs will take off as well. But looking at this, I think you could do better with this. Just looking at it and comparing it to some of the stocks, there are stocks that have done extremely well in property space that have done better than this. But I think this will take out these highs. Over time, we're going to see these highs broken.
All right, well, thanks for that, team. It was great for your commentary on that. Now stay with us, as we'll be right back after this short break. This week on Talking Wealth, learn how to stop waiting and start living now with Travis Bell.
All I want you to do is write down that bucket list item based on your what and your why. The how will show up.
Want financial independence but don't know where to start? Take charge of your money with Jackie Clark.
Invest some time in building your own knowledge. When you have some knowledge, you want to hang on to that. You want to continue to build on it. And there is a path to navigate through tough times.
Unlock global talent and supercharge your business growth with Ronan Leonard.
At the end of the day, your job isn't to be the best carpenter, plumber, technician, accountant. Your job is to be the best business owner. Employees make you wealthy. Yes, they're hard work, but they're not as hard work as doing it all yourself.
Dale and I break down the financial sector sell-off in this week's stock market report.
The banks are talking about sort of the first quarter next year. They're not talking about October, November, December rate cuts.
To that point, could we now just be seeing a bit of anticipation from the market, which when we're talking about anticipation, we're talking in the realm of speculation.
Get your free 7-day trial now to watch this and more.
Only on Talking Wealth.
That's what's happening this week on Talking Wealth. Moving on, if you want to talk about a stock or ask a question, pick up your phone right now and give us a call on 0392909988, or you can text the number on your screen. Now, whilst we wait for your call, let's get into our next email. Now, Wendy is asking, would love to know your thoughts on Magellan Financial Group. I previously owned it in 2019 and did well on it. Sold a portion of the stock, however held some until the COVID panic when I sold the rest of my holdings. Do you think the current price action is looking good to take a position? I'm keen on it above $11 area. What do you reckon, Janine?
I like it, and we have been watching this one for a while. We've had a few people
We
writing
have.
about it. So really interesting choice, good choice. Looking at the chart there, you can see you've identified a really nice resistance level, which is a big tick. That's one thing. On the monthly chart, the thing is, unless you know technical analysis, how are you going to know where it could rise to or its potential? Because there are a few levels that are important, and you've got to have the knowledge to make a judgment call about where that could be. Because what could happen is this stock could shoot up, pull back, and you think, oh, the run might be over, but then there might be a stronger level above that it's more likely to run to. So at the moment, I'd be looking somewhere around, it could, I mean, this stock could double in value. It's one of those ones that I
If the
think...
market's going bullish, this will go with it, won't it?
Yeah, it's quite interesting. I mean, when you look at stocks like this, if we just go back to the chart, you know, often just with one eye, people, you look at it and you think, okay, it's got an all-time high of $71. Now that it's fallen off down to about $9, it should automatically in your mind thinking, well, it can get back to $71, and the stock might do that. But you've got to consider all throughout this run from 2011 to 2020, what was the tailwind behind it? Was the company growing earnings? Was it on a stellar run before things may have changed? So, you know, before you get so excited about going back to the all-time high, like Janine said, there's so many levels the stock's got to get through. Is there a short-term play in this? Absolutely above $11. But having that long-term mindset about hoping for the all-time high, you really need the company's fundamentals to back that up if it's going to get to those levels again.
Any good advice for Wendy?
I love it. Short-term play above $11, why not?
Okay, there you go, Wendy. Now we've got a text from Uru, who is asking thoughts on FFM, currently holding above $1. Looking to enter a trade through $1.13 as I see some large potential upside now. FFM, Phil,
Yes,
I'm not swearing at you. FFM.
FFM, Firefly Metals. All right, let's go to the chart and have a look for you. Huru, was it?
Yep.
Yep, cool. Great name. So, again, another stock that is coming off a real significant fall. We've got the all-time high back in August 2020. And look at this. I mean, what I want to show is you know, we talk about stocks. How do you identify stocks trading in euphoric stages? Now, if we bring out the monthly chart here, it's very clear. Look how sharp this run up in June 2020 was. It was 1 month rise. It's gone from about $1 to $3. That signifies euphoria. And so what followed was quite natural in the fact that it's gone back down, moving back to that natural gradient, which really the stock hovered at around 27, 28 odd cents for the most part of its history. And so you've got to ask the question why it's gone back down to these levels. But from a technical perspective, I really like the fact that it's come out of this low in 23. It's given 3 higher bases, higher lows with higher highs and breakthroughs, which you haven't really seen all throughout this downtrend. So right now, from the medium term perspective, the momentum is changing. It's just how much further does the stock have to go? And I mean, to put some levels on it for you here, and I don't want to call myself a senior, but I think I need to start wearing glasses because I'm struggling to see some of these markers.
Somebody called me a senior this morning, and I tell you what, I let them have it.
Didn't feel good, no, that's right. But getting through, I think this stock in the short term does have potential to around $1.45. And so keep that in mind. Potentially, even if it gets through, you might find some resistance. If we can just click on this through here, some resistance is at where it is right now. So keep a close eye on it. I'm sure he's got his stop loss and all in place. Risk management, that's the main thing you need to do.
Any words from the fabulous Janine?
It might have been a term of endearment, you know, a respectful
No, they
comment.
didn't. They said, why are you walking so slow? You're getting old. You know, it wasn't to do with that. Anyway, I was just being a gentleman and letting the ladies walk in front of me. So anyway,
You
any
are a
comments
gentleman.
on FFM?
I like it. I think it looks great. I just was interested in the weekly chart, just seeing these moves, how it's been moving up, and this consolidation is a classic sort of a consolidation. It got the breakout, you got the pullback. It's just beautiful. I'd just like to see it pull back from here and then start to move up again if you're not in it.
Well, there are Uru or Huru. I think your name's Kevin anyway, I think from memory anyway, but there you've got Phil and Janine's thoughts on FFM. Now remember to show your support for our channel and smash that like button right now. Next is Linda, who is looking to purchase Westpac Bank for the medium to long term, wondering if now would be a good time to enter, considering the recent pullback, which looks in line with the natural gradient of the stock, or would I be better to wait for its break, or for it to break the previous high of 33.78? Now, we did bring that up just a few minutes ago in our main topic. So what do you reckon, Phil? What can you add to it?
So very similar. I mean, let's just go to the chart there for you. But there is an option to buy above that 33.78. Really, to me, if it's an income play, then fine to buy at these levels. But I think there is a better opportunity technically coming, especially with the gradient of this rise. And it is coming into a particular level where there is resistance for this one. So it's right now it's trying to, let me get the black horizontal line through here. Right now it's about weighing up the risk-reward scenario. So if we are coming into some previous resistance through here and buying above 33.78, you're potentially looking at, about 4% upside before you could meet some significant resistance. So to me right now, the risk-reward scenario doesn't line up at these levels, yes.
Okay, wise words there from Phil. Now we've got a text from King, who is asking, following the short, sharp correction in August, I had 2 sell signals and my portfolio dropped from 8 stocks to 6. Now following the recent rise in the financials, I've ended up with MQG, or Macquarie Group, now being at 19% weighting. I'm not concerned and I'm watching some stocks for entry signals, but I am curious as to how to respond to this. King, I'm going to go to you, Janine, because you're our portfolio queen.
I really like Macquarie, so great choice. You couldn't have a better stock in your portfolio, in my view. And this run that it's had, it's just incredible. Look, right now, if you're holding it, I would just continue to hold it. For those who are looking to buy it, I'd just be watching it and waiting for it to settle down a little bit. It may pull back. It's had the last 1, 2, 3, 4 months up. So, it's not very often that Macquarie runs for more than 5, 6 months before it has a pullback, you can see in history. So it could do that, but if it takes off through the high, like Phil showed on Westpac, it could run for a few more percent before it peaks out.
Now, obviously he sold a couple of stocks. He had 8, and if he did his portfolio position sizing based on 8 stocks, that would have been, he would have put 12% in each position size. So he's got Macquarie at 19%, because now he sold 2 stocks. He's got cash ready to go in. Should he be concerned about it being at 90% weighting on his portfolio?
Not at all.
Okay, why?
Because you want to actually allow that capital to grow. So a lot of big fund managers, what they'll do is they actually trim positions off to suit weightings. And I think this is where a lot of this thought about, is that too much compared to my other positions? Is that a problem? It's what industry talk, that's industry talk about rebalancing portfolios, which don't do it. Just let your profits run and find a good solid rule to manage Macquarie, which a trend line is a really good rule. Get Dale's book if you haven't. If you're a student, then you've got those rules available to you.
Yeah, I think it's what you've just said is perfect, because I think I've had so many people say to me, oh, this is 25% of my portfolio, I'm overweight and it's high risk. I go, no, it's not, you're in profit, aren't you? And they went, yeah. I said, who cares? Because even if it drops 5%, you can still sell out at a profit. But what you're saying is the managed funds take money out of stocks that are going up to put it in stocks that are lagging, to rebalance you back to the same weighting to reduce risk. But that's because they don't use exit strategies, which is, you've got those up your sleeve, King, so you know what exit strategies are and how to use them, so you don't need to worry about it. But let's move on. Now, Scott is asking about market orders. Scott's saying, I put an order on today at market when the price was trading between buyers at 13 cents and sellers at 13.5 cents. Yet my order was filled at 13.75 cents. The note from the broker states, market orders are placed 3 price steps above the best offer price at the time the order is processed. Does this mean even if the current sellers are at a certain price, your order can be filled above this price? Now, that's a really interesting one, isn't it, Phil? I know you've delved in these sorts of stocks before.
Yeah, it is. It's very interesting because you're talking about a little bit about the dynamics of the market, the way it does work. Now, obviously, CommSec has given you a nice little disclaimer there on what can happen, and that's a question in itself, trading at market price. In order to, I guess, avoid this situation, you probably want to maybe switch the way you're doing your orders and put limit price orders that would cover the fact that you're only going to get transacted at the price you want. But it's quite normal. I mean, we spoke off air about, I had an experience with a guy working for one of these algorithmic type firms in Holland. And so there can be situations where, you know, these really short, fast algos are picking up the entry just before you may be getting in and then selling it on at a little bit of a clip or a high price.
Because you put your order in without a limit.
Without a limit. Or it might just be the fact that someone else came in just before you, 4 seconds before you, in fact, with the stuff that you sent through, and took up all the orders on the offer price, meaning that you got the next best fill because you've got no limit set, you're straight at market. So a multitude of things could have happened right here. I mean,
CommSec's a reputable organisation. They've got rules in place. They've got a policy. So is it that, you know, Scott just wasn't aware of what the policy was and didn't understand, and this is really a lesson in how
it's
this
possible.
whole
I think I'm not sure
thing
whether
works.
if that's the case, but I mean, Scott's just trying to understand what actually happened. I know some traders don't understand who they're trading with, and we see that all the time with FX.
Yeah, market makers.
We see it so often with market makers, and all FX brokers are market makers, but even in CFDs with market makers, and people trading with algorithmic broking firms offshore, we see it, they don't understand what they've got. They just throw some money in it, and then they think they're making money until they stop making money. Because
so their portfolio or their account keeps growing and growing and growing.
Yeah, that's to
until
entice
all
them
of a
to put
sudden
more money in, and once the
get wiped out.
once the trader puts about $5,000 in, then they start losing, and they lose all their $5,000, and they can't get their money, and all these excuses come up. So this is not the case here, but I'm just saying I suppose my story is about a lot of traders don't understand the broker that they're dealing with. I don't think that's the case with Scott, but it's more about understanding the situation. Because
But the other side is, should each individual know this? I mean, not from, you know, should it be brought to their attention?
Well, they should read the fine print on how trades get placed in the broking, rather than just look at the order pad and go, here. They should be looking at how the brokers place their orders and what their rules and regulations are around it, so you can then set your strategy around that. Yeah, and this is what Phil was saying. So maybe on a stock that's around 13 cents, you probably wouldn't do it on a BHP or a bank.
It's not even an issue.
You wouldn't do it.
One.
You'd be doing it on these smaller stocks where that half a cent can make a big difference in percentage terms. So you'd be doing it on those sorts of stocks. So that's, I mean, some great advice there for you, Scott, from Phil and Janine, in helping you hopefully understanding what's gone on there. But you know, good luck next time, and just make sure you read the fine print and understand exactly what's happening. Now, if you enjoy watching and want to see loads more of our content, click subscribe now. Subscribing helps others find our channel so we can help them too. Now we have Sean, who's asking about the future trend of XRF. Its financials are looking good, rising ROE or return on equity and other metrics looking good, and pays a dividend. It has trended nicely for the last 12 months, making higher highs and higher lows. I don't own the stock, but I'm looking for an entry point when it pulls back. Do you think it will continue to trend? And I was thinking $1.48 as an entry price. Now, what do you reckon, Janine?
Well, look, I think it looks good. It's just broken out through previous highs here. It had 2 tops there showing the strength of resistance, and then another one here. Obviously, the ideal time when looking at this, I'll just grab that horizontal line, would have been once it broke through it, came back, tested the level, came back, tested it again, it's taken off again. But, you know, I don't have an issue with picking it up now, even given it's just proven all of that in terms of a breakout. The only thing I would say is that 1, 2, 3, 4, 5, 6, 7 months straight up, what's the chances of it continuing to go up for much longer than maybe a month or so before a pullback?
Well, the rising ROE generally means rising earnings, so that as a tailwind is a reason why it could keep going up on from here, particularly if those things keep increasing and getting better. But if we go back to the chart, really to identify whether we are at the end of a run, we do want to see that blow off extension type move, which we kind of saw through here. Right now I'm not seeing any of that, so we could potentially be continually rising in trend with this one for some time to come, especially with the fundamentals backing it up.
Well, there you have it, Sean. You've had the expert's answer on your stock. Now, before we let you go, what was your favourite part of the show? Was it our hot stock tip, or Phil's hot stock tip, the Brownlow medalist over there, our topic for the night, or was it a viewer question? Let us know by commenting below this video. Now, thanks to all those who are watching on YouTube and Facebook. If you're watching on talkingwealth.com, stay tuned for for more exciting stock picks, insights and strategies. We'll be right back with all that and more. Next week in our main topic, we get into will fossil fuel commodity stocks survive? The future of coal and gas in a clean energy world. Make sure you join us next Tuesday night at 7 p.m. Australian Eastern Time. Now, if you love our show, remember to hit that like button right now and subscribe to our channel, as this shows your support for the team that puts in the effort each week into bringing it to you. If you are subscribed, then you'll always know when we go live and put up new content. As always, thank you for joining us. For now, goodbye, good luck and good trading.